Good morning, good afternoon, good evening, no matter where you are in the world. This is Howie, and I'm here to help you win with money. It was a great week. Everything is green. New records for Dow, S&P. This is wonderful. And we'll get into more details of what we're going to do. I'm going to do my weekly summary of my trades. And I'm pretty sure I lost money because I did a video on that on Monday. But I asked you guys, guess how much? We'll find out today. So stay tuned and we'll see. At the end, I'm going to do a little bonus today. And the bonus is I'm going to teach you guys how or why people use options to hedge against their other portfolio that they have. And I'll explain that further. And before I move on to the meat of the video, if you guys want to level up your investing knowledge, please join me in a Facebook group, Investing 102 right here. You can join me there. And that's a great place for you to learn, ask questions with other seasoned investors. So hopefully I'll see you there. As always, I'm just going to copy in all the transaction logs. So I'm probably not going to speak much here. So I'm going to just find the last day. I'm going to copy everything in. Okay, the first thing you're going to notice is the ROKU expired last week. So we're going to make sure we copy in all the 5th. Paste. Copy. Paste. Let's get the 6th. Copy. Paste. The 7th. And we're going to paste that. I did not have anything on the 8th, so I'm going to copy the 9th. And paste. So let me double check. I finished populating all the fields. And I don't know if there's an error until I do a pivot. So I'm going to hit the save button. And then let's go and pivot this data. I'm going to the top. Move over here to the side over here. And you guys see this all the time. I'm going to hit the refresh button and see what happened. Oh, and this is exactly what I was going to tell you. I suffered a lot of losses here and here because I started to move my positions. And you see that. It was really bad for me. And there's no good way to say it. But let's see what the final data looks like when I finish pivoting everything and double checking on the data. Come over here. I'm going to hit the pivot table in here. Okay, and there you go. So April is really bad no matter how you look at it. And it's all because of the S&P 500, iron condors. You see I actually made money on cover calls. My dividend is only $1 this month or so far in April. Cover the iron condors, again S&P 500. And the other stuff, while they're small, they're still making money. But this is going to be a hard month to make money. And I can explain further what happened. So let me just double check all the numbers. I'm going to paste in my number here. And you see how the data is dropping. So that number is week number 14. Let me just fix some of these things real quick. And here you go. I looked at the numbers. This looks correct. I dropped $1,000. And it's my first negative week because S&P moved basically in one direction further than I normally would expect it. And I don't remember exact details, but it was 7 or 8 days. Obviously, there's new all-time highs, multiple days. There was very few red days or down days. If I would have made money if it stayed in the range, but it didn't do that. What I ended up doing was over here, if you notice, I started closing out some of my riskier bets. If I actually did it in any of these days here, it would have saved me a lot of money. I would not have to take this $2,000 loss if I knew it was going to go green, 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 green. And I didn't know that. So I took a big loss, and there's really not much I can do. I'm still playing the same strategy. You can't win 100% of the time. Does it bother me? Absolutely. It's real money that I'm losing, and it really stinks. And obviously I had a nice green track record for the first quarter, and April's looking really bad, and I don't know how it's going to end. So let's start with a summary of ROKU. I've been playing ROKU, really short trades. You see that? These are I did do a, hang on, let me fix this. That was a credit spread, so I'm going to fix that. And I made money on the credit spread. These were 1 days. This one was a 2 day, and so you can see that I made money here. Not a lot, it's 26 bucks, but I did it again here. I made 20 bucks here. And in the previous week, I did it again and I made 25 bucks. So when you add it all up, that's $73 in profit, risking 1,000. So that's 7% in 3 weeks. Again, is it a lot of money? No. The whole thing is I'm trying to layer on all my strategies together. So the goal is you don't want to lose money on one strategy if that's your only strategy. Because if I did 100 contracts, well, I can't afford 100, but if I bought the maximum contract that I have in cash and the strategy went against me, I would have took a much bigger loss. But because I'm using cover calls, I made money there. Because I am using credit spreads here, I made money on ROKU. I was doing some other cash secure puts, they made me money. So really the only loser this week was the S&P 500 doing an iron condor. And I have a whole bunch of those. I may have 15 or 20 contracts open and they were at risk and they were tested and it caused me to lose money. Let's examine the cash secure puts that I did last week. They're all in red. If you just do this, you'll see how much money I made. $155, and most of it was rolling down and out because I put cash. Remember, I'm locking up cash to bet on a put, and the put is now, some of them are in the money, some of them are not. So I'm just rolling down and out. Every time I'm rolling down and out when it comes to cash secure puts, you're releasing some buying power. So that's a good thing. And I'm still collecting a net premium. And you see I did that the other week too. And we'll just take a quick look at the data there. Last week was 177, and so in 2 weeks, just in cash secure puts, $300. So this is why I teach you want to use multiple layers, multiple strategies. You layer them all on top of everything, and that reduces some of the diversification risk. If you have different strategies, hopefully not all of them lose on the same time. You can make money some ways, and other ways you lose money. So let's see what else I did. So let's just go straight to the S&P 500. You see that these were fixing the high risk ones. I was closing the high risk one. I closed some high risk one last week. There is some things that I did to try to reduce some of the pain, which still didn't help. As you can see, I rode some of the put side closer to collect some more premium, and then with the hopes that the market will sort of settle between the two legs or the short legs. And that didn't really happen. It just basically it kept moving towards my short call leg. And then you see that I've been rolling. I've been trying to fix some stuff. Not much I can do. It's a hard game to play sometimes. So I did lose money this week. But before you go on, I'm going to show you something that you may actually find more valuable. So don't go. I'm going to show you why people still use options trading to hedge their portfolio. And this one is a little bonus content. So I created a simple average investor portfolio that just has two components. It has like a work 401k plan and an IRA or something like that. And I mocked up different cases. So these are like case number 1. And the reason why I did this so that I can show you what a portfolio looks like. I use formulas to do it. Here's a case where the market drops 13%. So your free 14 becomes 273. If it drops 5%, it's 298. If the market is flat, obviously it's the same value as what you see here. If the market is up 6%, it's this value. And if the market is up 9%, it's this value. So why is this important? I'm going to explain to you. This is a typical investor just doing the plain Jane buy and hold dollar cost average for your 401k plan. And that's what will happen based on different market conditions. And now I want to introduce a different concept. So if you're the investor here and you have this portfolio, what would it look like if you layer on an option strategy? So in this scenario, I assume that the guy will be shooting for a 0.05 a month. And you see the formula, I'm only using a small percentage of the $80,000 that's in his IRA or the Roth. And that means he'll make $400 a month on average, using a very conservative sort of guesstimate. And then what I did was I modeled it out for different scenarios. And the numbers you see here, I multiplied it by 12 because I want to show you what the difference is in a year. So if this market is flat, it's 314. But a options trader who uses sort of a very neutral strategy, his portfolio will be either 319 or 324, or depending on how much he makes on options. You can see how no matter which one you look at, this number will be greater than this number. Now, what happens if the market goes down? If the market goes down, he made 298, and if he was making a 0.5% a month, he collected another $4,000 at the end of the year. His portfolio is this value. And what's the point here? Somebody who layers it on, even if the market is down 13%, his value is still a couple $1,000s more. And so what I wanted to do is, let's not distract us. So I want to hide some of these fields, and let's not assume that you're going to make any of that. So we're going to hide those. So let's just focus on one of these. If you were making 1% in options with an $80,000 portfolio, that's about $800 a month, not a week. This is a month. So I'm using some conservative numbers. And then you multiply it by 12, you get your $9,000. So you can see the value. In down markets, this guy still has more money. In up markets, this guy will have more money. In flat markets, this guy will have more money. Well, you get the trend here. As long as the option trader doesn't lose money during the year, and it doesn't become a drag on your portfolio, but more of a helping your portfolio, why would you not want to do this if you're comfortable doing it? 2, you know how to do it. And 3, you understand how to play it so that you're not shooting for the moon here. You're trying to just collect some extra income every week, every month for the rest of your life on top of what you're already doing. And hopefully you'll get that, because I'm going to show you another slide. This is all bonus content. People need to go and find this one. So let's go and do a quick little lesson on stocks and options. You guys remember how to level up using the stock market and what you can do? Well, I'm going to further explain this concept by updating this slide, or not updating the slide. You see how I talked about this in the past. If you add an options trading on a level 102 on top of your, let's assume this is your 401k plan, right? This is the level that everybody can do. Everybody can do this, but you want to add this options trading on top of it. So what does that mean? So let me tell you, there are many ways to play it. I'm not going to tell you how to play it. Some people collect income. You can use cover calls. Some people make speculative bets. Some people use it to protect all their gains that they made. Let's say you made, I don't know, 5,000% return on Tesla, and you want to use options to protect some of your gain. What if Tesla drops to $100 a share in 2 months? So you can use options to protect some of your gains. So this is how you can use options as an insurance hedge. But there are many ways to play it. I'm not going to explain all the strategies. You can Google it. You can find really great videos out there. What I'm here for is teaching the theory and the concept of how to layer this on into your existing strategy. 80% of us, or maybe even more, may have some type of retirement account, 401k plan, 403b. Maybe you have a pension still, but most of us have some type of an account that's associated to the stock market, where you have an option to peg it to the stock market. Why not then use options to hedge, where you can reduce the risk in all market conditions and structure it in a way that makes sense for your portfolio? Again, this is no easy, simple thing. I'm just going to fly right through this. If you need some additional help, this is where hiring a professional or somebody who really knows what they're doing to teach you how to protect your portfolio. There are many, or you can try to learn it on your own. But obviously, if you don't know what you're doing, just be really cautious. Let me show you what this looks like. So I built this chart and I broke it into a different way using this is the options move, and this is what happens to the underlying. So I know it doesn't make sense right now. Let me add in another column here, and you'll see it in a second. So for people who does not do any type of options, your portfolio looks something like this. When the markets go sharply down, your stocks will lose money. When the markets move slightly down, you're going to lose money. When the markets are flat, you're going to be even. When the markets move up, you're going to make money in your stock. When it moves sharply up, you're going to make money. Now, let me explain to you what happens if you're just an options trader with no, let's say you don't keep any of the underlying, no 401k, nothing. So treat it as a separate thing. And if you're playing sort of the similar strategy to what I'm doing, I'm sort of playing this concept of I'm gonna say I want markets to stay in a range bound move, and sharp moves are the only way I can lose money. So if you're playing options that way, and I know there's many ways to play, so I can't cover everything, but I'm gonna explain to you how I'm layering it on top of my 401k plan or other investment that I have. So I'm going to explain it from my perspective. I obviously can't cover everybody else's and what they're doing. But here's a scenario. I only lose when markets move sharply up, or I only lose when markets are sharply down. And I did that reverse. I'll do it again. Sharply up is this side, sharply down is this side. My options will lose money. What's even worse is when you have two things that lose money at the same time. But if markets are range bound and they're sort of trading up and down, when the market is green one day, green, red, or two up, two downs, and that's the pattern, what that normally means is it's going to stay in between this sort of scenario. So you make money. And the odds for me making money in this scenario are roughly 80%. Sometimes it's 85, maybe 90%, depending on what happens that week. The only times you lose are when markets do something beyond what's normal. And in my case, I'm playing maybe a 1.5%, 2% deviation move. Or, maybe closer to a 90 percentile, 95 percentile of risk. And mine's a little bit more complex, but I'll get into that a little bit afterwards. So let me layer on one more column. I added a column for dividends. If you have a background in DRIPs, or dividend reinvestment plan, or DGI for dividend growth investing, this will make you, I think you will understand this. For other people who don't care about dividends, you may not even understand why I'm putting it in here. But I'll explain. If you're a buy and hold investor in a dividend stock, and if the market moves sharply down, while your stock lose money, your option can lose money, your dividends can actually make you money. There's an assumption here that the stock is not going to go to zero, that one day in the future, the stock will eventually recover. I don't care if it takes 1 year, 5 years, or 10 years. But people who collect dividends and reinvest it, they don't really care. They have this long time horizon. So when the markets drop sharply, my reinvested dividend make me the most money, hence the darkest green. When markets are flat, I can still make money with dividends. I'm just buying it at the current market price. When markets move up or sharply up, my dividends will make money, but less, because I'm overpaying for the shares at the current market price, and you buy less share. People have taught this over and over. You make more money in dividends when shares go down. So dividend itself is a built-in hedge because most stocks pay you dividends 4 times a year. So this is a hedge in one point. Options can be a hedge, and depending on how you play it, but most people can do it 12 to, I don't know, I'm going to make some numbers up. Maybe you'll do it 20 times a year, depending on how you trade. 20 times a year. And if your stock is underlying, maybe your dollar cost averaging it maybe 24 times a year, right? You're buying it through your employer. So that's sort of what it looks like. So one last column I'm going to add in here. And you see what I just added? What's the end result when you combine all these strategies together? And I'll explain with this one. If the market was to drop 5,000 points on Monday and next week, what will happen? Your stocks will lose value, and that hurts. Your options most likely will lose value unless you were predicting that move. And then your dividends, right? You can make some money, but it has a very small impact because the dividend is less than It's really less than 2 or 3 or 4% divided by 4. So it's a small impact of your overall portfolio. And so the end result is this is the most painful scenario. You're going to lose money and nothing will help fix that. Unless you had another type of hedge. Maybe you're playing it on the VIX or something. There are ways to play this long tail risk protection. There are people who play the volatility index just as another hedge. So there are many ways to structure this. I'm not going to cover that today. But here's another scenario. In this scenario, if you lose money on the underlying, that can hurt because, right, if you're over here and let's say you lose slightly, so it goes from this value to this value or 314 to here, but you made $9,000 at the end of the year extra, so your total portfolio is 308, which is only $6,000 away from when you started, even in a 5% down year. So in this scenario, you lose money on the underlying, you made money, so it's painful. You still lost money. If the markets are flat, your stock made no money, your options made money, and your dividend strategy made money. So that's a profitable end result. Now, this one is a much better result. If the markets move slightly up, you made money on your stock, you made money on your option, and your dividend made money, which I made this a more profitable scenario than this one. And if I wanted to do this right, I should have colored this one darker. What happens in a week like last week where the market moves sharply up? I made money in my underlying, maybe 3%. I don't remember what the total move was last week. I lost money on my options, and you saw how much I lost. I lost roughly $2,000 on that one day, on Monday. But at the end of the week, when you sum it all up, I mean, I still lost some money, and it's not it is a big deal. I'm sorry. It is a big deal. I lost money. But I made some money, not on the dividend, because you saw, I think I had $1.77 or something ridiculously small. But it's still profitable. And why is that? Because sometimes it depends on the ratio of how big your 401k plan is to the size of your options portfolio. So I'm okay with the markets moving 2 or 3 or 4% a week because this here made me money. And it's offsetting a little bit of what I lose. Now, if your portfolio is like a 50-50 split, it is possible that all your losses were sort of canceled out by your gains. But in my case, the way I structure my hedging is I make sure I don't bet too much on options. Options is a small percentage of my portfolio that adds a decent amount of extra dividend kick or extra premium value because that helps me have more scenarios where I win, right? My goal is even if you're losing money, I want to try to make money still because most people only do this strategy. This is the level 101 strategy. I'm trying to do all this combined together, more in advanced level 102 thinking. I'm stacking all my strategies together to try to make money almost in every scenario possible. I'm trying to design a way where I'm okay with making less profit as long as I have more chances of making profit throughout the history of your trades. Anyway, I went really long. Hopefully you enjoyed this, my bonus content. If you like it, please give me a thumbs up. There's not a lot of people who teach this stuff. They just want to teach you, well, a call does this. You can buy a call or sell a call. Here's how you do whatever. They're too basic in their thinking. It's time to move on and learn how to do this, structure it with a real live portfolio with what people do. And this is what I'm doing. Everybody has a different strategy. Not everybody hedges the same way I do. Some people just don't hedge. They just don't care. But that's fine. I'm not here to convince you how to play it. But this is what I'm doing. Hopefully you enjoy this. I want to help you win with money. I want you to make $1 at a time. Let's do this 1,000,000 times. You'll be a millionaire. It's easy as that. And again, I always say this. Have a profitable week. Bye-bye.